You are listening to Keystone's Stock Talk Podcast, episode 74. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. This week in our Your Stock Our Take segment, we take a look at Alacer Gold Corp, symbol ASR on the TSX, a low-cost junior to intermediate gold producer with two producing operations in Turkey. The company recently completed a significant sulfide production plant at its Çöpler Gold Mine, which is now set to produce 3.5 million ounces at low cost, generate robust cash flow for approximately the next 20 years, albeit in a very risky geopolitical arena. With the uptick in the price of gold, a listener asks us if Alacer is a good option going forward. Our star of the week is Skechers U.S.A. Inc., symbol SKX on the New York Stock Exchange, the popular marketer and manufacturer of Skechers brand lifestyle footwear for men, women, and children. The stock is up 15.5% this week, 25.5% in the last month, and 33% year to date. We let you know what is driving the move and whether it is sustainable. Finally, our dog of the week is NFI Group Inc., excuse me, symbol NFI on the TSX, a global manufacturer of buses operating under several brands. NFI vehicles incorporate a wide range of drive systems, including clean diesel, natural gas, diesel electric hybrid, and zero-emission electric applications. The former TSX darling has seen its share price drop 12% over the last 6 trading days and around 19% over the last month. Is it a dog or opportunity? We will let you know. Well, we're going to kick off our show. I'd like to welcome my co-hosts this week, both Brennan and Aaron. Welcome, guys.
Good morning. Good morning.
Hello, Ryan.
As I struggle through a massive frog in my throat, I did see that you had no frog in your throat this past weekend, Aaron, as you were a guest on Money Talks Radio with Michael Campbell. How'd that go?
Good. Was that the only thing you noticed, that I didn't have a frog in my throat?
No. Basically, that was about it.
That's
about all I could see with you.
You're just focused on that. No, the radio show went great.
It's about the most interesting thing about you, right? So.
I always love doing the show with Michael. He's a great interviewer. So we, for anybody who hasn't seen it, there is an archive available. I believe it is also posted on Keystone social media, or will be, but I'll check into that. But there is an archive available. So we had a great conversation. We talked mostly about income producing companies, our Canadian Dividend All-Star report, which we put out last month. So that was the culmination of researching every dividend paying company in Canada and then coming up with an 8-stock portfolio out of that, and a 25 stock monitor list as well. So we talked a little bit about that, a couple of recommendations. I updated Microsoft, which I'd recommended at the World Outlook, and is up 30% since. So I gave my opinion on that. Talked a little bit about Brookfield Infrastructure, which is a company that we've covered for a while in our conservative dividend space. And then we also talked a little bit about Zynex from our U.S. growth stock research, which we just put out a sell recommendation on after it more than doubling in the 6 months before. So it was a great interview. I really love getting into the fundamentals of what we do and what we're looking for and what we're trying to achieve for our clients with Michael.
Yeah, and if anybody who has not heard that interview, I encourage you to go to keystocks.com. I believe right on the front there, you can click on that and listen to Aaron's segment of that entire show. And like he said, he gets into some great topics there, talking about the Dividend All-Star report, and even getting into a company that I had recommended on Money Talks just in April of this year, Zynex Inc., which we has doubled since that point, and we took our full position out of the stock. And it's just one of those cases where it's not a company that we hate by any means. It's just when we originally found the company, it was trading around the $3 range around 18 months ago. Produced good solid cash flow and earnings, graduated from the OTC to the NASDAQ, which is what we like to see, continue to produce good solid cash flow and earnings. But when we originally found it, it was trading around 10 times earnings with a cash-rich balance sheet. And when we ended up selling the stock, after its shares had risen over 200%, the company was trading around 35, roughly 40 times in that range earnings. So a good company. Was it trading at a reasonable price given some of the risks of the company going forward? We didn't think so, and we took some of our profit off the table. And one thing I can tell you, you are never going to lose money selling at a 200% gain over time. So that, sometimes you have to pull the trigger and take some profit out of a company, and that's what we did on that situation. So it shows you not only do we have the buy recommendations, but we give you an idea when to sell a given stock. So we're going to start this week with our Your Stock, Our Take segment. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. We have a question that came in from Emil in Edmonton. He emailed in the question. It says, I know Keystone has profiled Alacer Gold in a number of your cash-rich special reports in the past. The stock has performed very well this year. What is driving it, and how do you feel about its prospects going forward? Well, Alacer Gold Corp, symbol ASR on the TSX, is priced around $4.96, about a $1.45 billion market cap. What does the company do? Alacer is a low-cost junior to intermediate gold producer with an 80% interest in the world-class Çöpler Gold Mine in Turkey. The Çöpler Gold Mine is processing ore through two producing plants. With the recent completion of its sulfide plant, the Çöpler Gold Mine will produce 3.5 million ounces at first quartile all-in sustaining cost. That means low production costs, generating what management believes will be robust free cash flow for the next 20 years approximately. Now, Alacer continues to pursue opportunities to further expand its current operation base to become a more sustainable multi-mine producer with a focus on Turkey. While we consider mining and mining-related stocks to be relatively poor investments, generally long-term, particularly junior exploration and production companies, as the listener points out, we have profiled Alacer in the past due to its strong balance sheet, low-cost gold production projects, and potential to be a strong cash flow producer over a relatively long period. The stock has performed very well already in 2019, up 93%. In the first quarter, its new sulfide plant came online at the Çöpler mine. Production grew to 89,000 ounces, generating positive unlevered free cash flow of around $35 million. Management reiterated the company is on track to meet its full-year gold production target of between 320 and 380,000 ounces. From its two producing plants. That is up significantly from 2018. Our take. In the first quarter of this year, year-over-year gold price was actually down about $26 U.S. per ounce from the previous year, but this has reversed significantly in the second quarter with gold moving to new 5-year highs. Couple this with production gains from the new sulfide plant at the Çöpler mine, and one can see why the share price has jumped. Trailing 12-month EBITDA is about $108.4 million at the company's highest point since 2015. We expect this to continue. Debt levels are a little higher on the high end as we see its net debt level at 3.9 times its trailing 12 months EBITDA. With the recent expansion, which it has been planned and now come to fruition, the cash flow will likely allow the company to quickly deleverage. Company's trading at 14 times EBITDA right now, 1.2 times book. These valuations are slightly pricey given the company's dependency on economic factors such as gold, the price of gold, as well as the above average geopolitical risk from the mine in Turkey. However, with the company's low production costs, and if gold remains in its current range or moves higher, the multiple should become significantly more attractive by year's end and over time. It appears that management is executing well, but the price of gold over the next year and moving forward typically determines the fate of a gold producer such as this. If the company continues to execute and gold moves higher, the shares likely do well. Even if management does continue to execute and gold moves lower, the shares likely underperform the market. That is the rub with speculation in gold-related companies. For those who want to speculate on higher gold prices, Alacer is an option, but the company has priced in its current positive news near term, nearly doubling already in 2016. We'll certainly continue to monitor Alacer Gold.
We do get a lot of questions from clients, I find, on gold and silver producers, and there are some companies out there that are doing a good job with respect to expanding their production, expanding their resource. But of course, Ryan, what we always say is that ultimately the success of the company often just comes down to what happens with the commodity price, and that's something that management has no control over.
Yeah, basically, I mean, management has to execute very well. And, that has to be taken as a given, which isn't always a given. You don't always see that. So you have the execution risk that you have in all businesses, really. And then they have the wild card to the commodity. And if gold produces well, or gold continues to go up in price, the company does well. If it doesn't, then the company likely underperforms the market. This company may outperform its peers because management is executing, but there's not a lot of capital going into the sector unless the price of gold is going up, as it is right now. So the wind is at its back, so to speak, for the near term. So we're going to get into our weekly star. From our Stars and Dogs segment, it's time for this week's Star. Our star this week is Skechers U.S.A. Inc., symbol SKX on the New York Stock Exchange. Brennan, I'm going to let you take that one.
Thank you, Ryan. So, Skechers U.S.A. Inc., again, ticker symbol SKX on the New York Stock Exchange, currently trading at a price of US $39.63 and has a market cap of $6.4 billion. So, the stock was up 15.5% this week, 25.5% in the last month, and is up 33% year to date. And just in the last week, the stock did hit a new 52-week high, going from around $33 up to around $39, testing previous highs made in early 2018. So Skechers U.S.A. Inc. is a designer and marketer of Skechers-branded lifestyle footwear for men, women, and children, and they also have performance footwear for men and women under the Skechers Performance brand name. And of course, they do also offer apparel, accessories, eyewear, scrubs, and other merchandise. Now, what is driving the stock? On Friday, July 19th, 2019, the company reported better than expected Q2 financial results, and the gain was essentially propelled by impressive growth in international sales. And this is a substantial part of sales, as international sales comprise of about 55% of the company's total sales. And these international sales were up around 20% for the quarter, driven by men's and women's sport and men's and women's street footwear sales. And the COO, David Weinberg, did state that the second quarter's record performance was a testament to the demand and strength for Skechers brand and products, and that the biggest dollar increase came from India, the Middle East, and China. So, taking a deeper look into the company's financial results, again, Q2 2019, for the period end June 30th, 2019, revenue increased around 11% to $1.26 billion from $1.14 billion over the same quarter last year. Net income increased 66% to $75.2 million from $45.3 million. And on a diluted per share basis, it was up 69% to around 49 cents per share from 29 cents per share for the prior year period. And now I do want to note that comparable same-store sales did increase around 5%, which is, of course, an essential metric to keep your eye on here for retail. So looking forward, management did give some pretty good guidance. So management expects for quarter 3 of 2019 that revenue growth will remain strong, climbing approximately around 13% from the prior year period. And as well, earnings per share will also increase to around 70 cents per share compared to 65 cents per share for the same period last year. Looking at the company's fundamental ratios, the company does trade at a trailing 12-month price-to-earnings ratio of around 19 times, which is reasonable. It doesn't seem to be too high and pricing in too much growth, I would personally say. The company also has a debt-to-equity ratio of around 0.05 and a current ratio of 2.5. So the company is quite liquid, which we like to see, of course. So, in conclusion, given the company's impressive quarterly results and optimistic guidance for quarter 3 of 2019, the stock has risen considerably and claimed the coveted status of our star of the week.
Well, I can say that I have owned a couple pair of Skechers myself in the past, and I would definitely buy more. I like them. They're a decent shoe.
Yeah, definitely. And I know that the new styles are definitely picking up on the athleisure trend that is taking place. And that is the funny thing. I was hanging out with some of my buddies last week, and I complimented my friend on his shoes. I was like, wow, those are really nice shoes. And, of course, they were Skechers shoes. And that's the thing. Even from my research, I have looked into Under Armour back in the day, and I do know that Skechers is becoming fierce competition with Under Armour. So the company, they've definitely, been appealing to consumers. Sales have been increasing, and, the company obviously likes to see that.
And this is a good... Oh, sorry, Ron, I'll let you.
Yeah, well, I was going to say, on the other hand, as a contrarian, seeing that both of you like the brand, that makes me immediately want to hit the sell button.
Brandon's a young man, so he's in tune with the styles of the youth these days.
I just didn't want to single you out, Aaron.
I
don't want to single you out
when it comes to fashion. But this is a good point to make here, is when you're considering investing in a company, if it's the type of company where you can visit a location like a store and shop there, or if it's an apparel brand or a food, and you can actually consume it or see firsthand what the different products are, that's a way to do research. I think it was Peter Lynch that really pushed that heavily. He said, you got to go to the companies and actually look at them through the eyes of a consumer. And if it's a fashion brand that caters towards younger people, and you have younger people in your family, talk to them, ask them, is this something that your generation thinks is cool or would think is cool? And that gives you some great investment insight.
Yeah, I mean, the funny thing is, right before, about a year before, just under a year before actually, that we recommended Boyd, I had gone in and had my windshield replaced and had a good experience at a Boyd location just outside of Vancouver. And so, that it didn't spur the recommendation. There was the fundamentals there, but it obviously, it helps tick off a box that I had a positive experience actually utilizing the service of that company before we made a recommendation on that. And now Boyd has gone on to be the single best performing stock on the TSX over the past 10 years. So again, it gives you some anecdotal backing to your research that you've done on the fundamentals of the business.
Certainly.
Also, I'd like to know on Skechers, it says they do eyewear and scrubs. Does anyone know what scrubs are? Are we talking about medical?
Think scrubs, I think medical scrubs.
Yeah, that's nursing, and definitely.
Because what I think of the 80s girl band TLC, and I say, I don't want no scrubs, right? So again, maybe I'm selling right there. Yes, and one of Aaron's favorite songs. It is. Of course. Okay, so without further ado, we're gonna move to our weekly dog. From our Stars and Dogs segment, it's time for this week's dog. and I believe Aaron has that in his Skechers. Are you wearing them now, Aaron?
I am not. I don't have a pair right now, but this has made me think that I need to go and look at some of the new styles. So weekly dog. We'll start here with the weekly dog. NFI Group is our dog of the week. The symbol is NFI on the TSX. The share price right now is just over $31, and it has a market capitalization of just under $2 billion. So NFI shares are down 12% over the last 6 trading days and down 19% over the last month. The company's share price peaked in May of last year at about $60 per share. In the 3 years previous to that peak, NFI was a top performer on the TSX, but the share price has undergone a steady decline since it peaked just over a year ago. So what does the company do? NFI is a global manufacturer of buses operating under several brands. The company operates more than 50 facilities in 10 countries globally and employs approximately 8,900 people. NFI's vehicles incorporate a wide range of drive systems, including clean diesel, natural gas, diesel electric hybrid, and zero-emission electric. So what's driving the stock downward right now? Well, there are a couple things impacting the stock. Over the past year, we've seen general weakness in the company's financial performance, and this is after several years of strong growth in revenue and earnings. More recently, the company issued a press release on July 16th outlining its Q2 2019 deliveries, orders, and backlog. The backlog at the end of Q2 2019 declined to 9,997 units valued at $4.82 billion compared to 10,587 units valued at $5.16 billion at the end of Q1 2019. And this press release precipitated the share price decline that we've seen over the last week. Just looking at the company's recent financial performance, they put out Q1 results on May 8th. Revenue decreased 2% to $567 million. Adjusted EBITDA was down 18% to $60.3 million. And adjusted earnings per share declined 54% to 26 cents per share. The Q2 results are expected out in early to mid-August. So in conclusion, NFI's share price has had a rough week. The catalyst for this decline was certainly related to the lower backlog announced on July 16th. However, the bigger story is the near 50% decline in the share price over the last 14 months. Financial performance has really weakened over this period, and this is what's driving the share price lower. Long term, I believe that NFI is a very solid business. It's a global company. It's been completing acquisitions to further expand its footprint. And we do like the focus on energy efficient transportation. However, one thing that I did learn about the company when doing my own research is that NFI's market is cyclical. We would not advise buying into a company when the financial performance is trending lower, at least until we have some confidence that the business will start to turn around financially. So the company earns the award of Dog of the Week, and we're hoping for better performance in the future.
Yeah, the not so coveted status of our Dog of the Week. Status. Yes, of course, yeah. But no, it's a good summary on the company, and it's a company we monitor. But because of the cyclicality of the business, when you do see a downturn, and you're seeing a downturn in the backlog and the financial performance, we would stay on the sidelines at present and monitor it. And maybe it would be a more shorter term buy at some point when you saw a cyclical uptick in its industry.
Certainly, it's really, I'll just say it's really difficult to press the buy button when you're seeing that decline in financial performance, because you just don't know how low it's going to go. I've had a lot of questions about NFI over the last year because it was such a highly rated stock before it started declining 14 months ago. And we've sat on the sidelines, and we're glad that we did. And it's impossible to say at this point how low the share price is going to go until the financial performance starts to turn around. Our belief is that it will continue to trend lower.
I think in a situation like that, you'd probably rather see a more sustainable or concrete example or signal in terms of the financial performance that the company is turning a corner and turning around to a new cyclical upturn. Maybe miss 10% of the upside move, but get some confirmation that you are in an upcycle rather than catch the proverbial falling knife here, right? Is that what we're looking at?
Certainly.
Yeah, for sure.
That's great advice.
Good. Okay. I think that will wrap up our show for this week. I'd like to thank my co-hosts. I'll do that in a sec, but I'm going to remind you to keep your questions coming into our Your Stock, Our Take segment. We appreciate those every week. We're getting more and more, which is good to see, and we're getting to pick and choose the best of them right now. Again, I'm going to thank my co-hosts, Aaron and Brennan, for hosting with me again this week. I'm going to wish all our listeners and our clients profitable investing.
Thank you. Profitable investing.